Welcome back to our channel. In our last video, we discussed the first essential element of successfully selling a business: preparation and planning. We talked about cleaning up the physical aspects of the business, cleaning up the financials and the corporate books, understanding how the market is likely to value your business, and making sure that you, the owner, are ready for the sale. In this video, we address the second essential element of selling a business successfully, and that is listing and marketing the business for sale. So the question at this point is this: how do we bring a business to market without damaging it in the process? Now, selling a business is not like selling a house. When you bring a house to market, you want the world to know about it. The more people who know about it, the better. But when your business comes to market, you want to make sure that only the right people know about it. Consider this. If your biggest competitor found out tomorrow that your business was for sale, would it hurt you? If your employees found out, would they be worried about their jobs? If your customers found out, would they start looking for other suppliers of whatever product or service that you provide to them? And if your suppliers found out, would they start worrying about getting paid or their relationship with you? Unlike selling a house, selling a business isn't about broad exposure. It's about controlled exposure, exposure to the right people. Because if the wrong people get wind of a possible sale, the value of your business is going to be impacted quickly and negatively. So our central theme here has got to be this: we want maximum exposure to the right people with maximum confidentiality. So who are the right people? The first question to ask is, who is the most likely people, or likely person, or likely buyer of my business? Is it a strategic competitor? Is it a family office or a private equity firm? Is it an individual operator? Is it an existing company looking for geographic expansion? Is it a management team? Different buyers care about different things, and how you market your business must be based on who is likely to buy it. For example, a strategic buyer may care about synergies and market shares. A financial buyer cares about the discretionary earnings, the answer to the question, what's this business going to put in my pocket? An owner-operator wants income, but also lifestyle. They want to be a business owner. If you don't know who you're marketing to, you end up targeting everybody. Well, really, you end up targeting nobody. Your marketing will be unfocused, ineffective, and reach the wrong people. So first, identify the likely buyer. We've done 2 videos on this topic: the types of buyers and how to identify the right buyer for your business. I link to them both in the description. So everything else flows from that first step, identifying the buyer. Once we know who we're targeting, we can tailor our marketing materials, and we do so in layers, because there are 3 different and distinct levels of disclosure in a properly structured sale. Level 1, public-facing information. This is what you put in the online marketplaces, the listing platforms, and even Facebook or other social media. It must attract attention. It has to highlight the business's strengths, but it has to protect the identity and sensitive information. No company name, no address, no photos, no identifiable customer characteristics or references. No information whatsoever that would allow a reader to intuit the name or location of the business. Just enough information so that a reader would be able to make a quick decision as to whether or not this business might be worthwhile, might meet their needs financially and operationally. So, where do we get this information? Well, interesting enough, we get it from level 2. The abstract. When someone responds to a listing, we don't immediately send them all the information. We don't do a data dump. That's a critical mistake. Instead, We provide a 2 to 3 page abstract of, well, level 3, the Offering Memorandum, which we get to in a moment. So, what is an abstract? Well, the easiest way to explain that is to use an example. In a business that I had and sold in the 1990s, we had leases with all over and for hundreds of locations across the United States. And we dealt with the major leasing companies, the major real estate companies. Their leasing people would send us leases that were 70 to 80 pages long. But their leasing agents also sent us an abstract of those documents, 2 or 3 pages, that bullet pointed the salient points in the lease. None of the boilerplate was included. It was unnecessary. It was an abstract, 3 pages of this 70-page lease. That's what we want to provide here, an abstract of a much longer offering memorandum. So our abstract consists of the following sections. Remember, we're not trying to write War and Peace here. We want to be concise and succinct, but also maintain confidentiality. So we want to give a general business description. This can be just 2 paragraphs. We want to describe the industry, its growth historically and projected. We want to describe or clearly put in all of the income and expense information necessary at this stage, which is essentially a synopsis of 3 years, or including possibly a year to date if we're beyond the first quarter of their fiscal year. And we want to justify the price. Now, from the standpoint of justifying the price, we want to make sure that we add all of the add backs. We total those add backs, and we calculate the discretionary earnings of the business. Now, for details on how we do this, see our series, What's My Business Worth?, linked also to in the description. We provide a general description of its assets, such FF&E, furniture, fixtures, and equipment. We provide an estimate of value of the inventory. Now, we don't want to take an inventory at this point because it fluctuates, but we provide an estimate of what the inventory is worth on any given day of a year. That's it. Real estate. We give a general description only if any real estate is involved, but no specifics, no address. Facilities. A general description of the business's facilities. What kind of space does it operate in? We want to give a description of the training being offered by the seller, the length of time the seller plans to help in the transition. We want to outline competition, just a reasonable description of what the competition exists with the business right now. We want to outline the employees, but generally so. How many are full-time? How many are part-time? If appropriate, we might list them by department. We want to talk briefly about market conditions. Is the market growing? Is it fading? Is it steady? Will it be impacted by anticipated interest rates increases or decreases? And after all of that, we want to provide a summary of the assets and their value, discretionary earnings, inventory, FF&E, and real estate if there is any involved. And that leads us to the price justification. We want to explain how these assets relate to the price we've calculated. We include our multiple, and we include the basis for our multiple. Most people are familiar with the concept of multiples. Few people understand how they're calculated, but we want to put ours right up front. The important thing here is that we are trying to cull from the hundreds of inquiries we're going to get. We want to cull the riffraff. We want to cull the tire kickers, people who have really no interest. And finally, we want to include contact information. An abstract, and its objective, is to give prospects, potential buyers, enough information to decide whether they should move forward with continuing the conversation. Because many of them, when they see enough information, will realize the business is not for them. And we do it in this abstract form because we don't want to break confidentiality or risk exposure. You need to keep that in mind. And level 3 is full disclosure. This is the offering memorandum. This is the big document. The offering memorandum is sometimes referred to as a confidential information memorandum or a CIM. This is where we provide nearly every bit of information about the business we're selling, but not every bit. The objective of an offering memorandum is to answer every conceivable question a buyer could have about the business, essentially a level of data that would allow a buyer to arrive at a purchasing decision, pending only a visit to see if the location is suitable for their family. Now, I have to admit, we've never arrived at that lofty level of completeness, but that's our intent. Our goal is to make the due diligence period, which is very, very invasive, one of confirmation rather than one of discovery. The offer memorandum is where full financial details are presented. Growth opportunities are detailed. Operations are described thoroughly. Risks are addressed. Management structure and employee details are all disclosed. But it goes deeper than that. It tells the full story of the business. It in many cases identifies the business and sometimes even includes photos. Now, a moment ago I mentioned that we want to provide nearly every bit of information about the business we're selling, but not every bit. This is about maintaining a manageable level of confidentiality for as long as possible. But to accomplish our goal of making the due diligence period one of confirmation rather than one of discovery, we've got to go deep. And so we include some of the following items. An employee listing. It's a section that lists every position, its pay rate, the tenure of the person who's filling that position, that person's certification or qualification if necessary, any vacation or personal time or back pay rather, bonuses, etc., that have accrued but have not been paid, everything except the employee's identity. We do not disclose the name. We disclose all contracts and leases, again in abstract form, that the business is party to or subject to. For example, if the owner went into signed a lease for the benefit of the business, but the business is not a party to that lease. We handle these disclosures in a simple 1 or 2-line description of the agreement. For example, disclosing the existing of a lease would include what is the lease for, equipment, vehicles, space, the commencement and expiration dates of the lease, the amount remaining in the term, the rental rate and the payment schedule, any increases that are anticipated, and any other non-standard terms of the agreement. This is a contract or a lease. We do the same. We never disclose the counterparty of these agreements in the offering memorandum. Disclosure of these details is not done until we are well into and nearly complete with the due diligence. An offering memorandum, or a CIM, properly structured is 20, 25, and 30 pages long. Yes, the buyer will certainly want to review every lease and every contract, as well as interview the key employees, but we want to delay the disclosure of these details until the final stage of due diligence. Now, this is confidentiality we're discussing here. So why is this so important? Well, with the possible exception of the smallest businesses, confidentiality is critical in this process. We maintain confidentiality by controlling the information flow. Here's the sequence. The prospect sees the public listing. The prospect requests additional information. The prospect receives the abstract and a non-disclosure agreement. The prospect signs and returns the non-disclosure agreement requesting additional information. The prospect gets vetted, and only then is the offering memorandum released. Now, if you don't follow that order, you lose control of both the both the process and of your information. Once confidential information is released, you can't get it back. This suggests that if you're a business owner trying to sell your own business, you set up a private email address that doesn't have your name and it doesn't have any reference to your business. And if you're going to include a phone number, we suggest that you get a cell, but your outgoing message doesn't have your name or your business or what the call might be about. In a worst case situation, or perhaps a best case situation, go to Walmart and get a burner phone. So the process is this, and this is the sequence. Step 1 is identify the buyer type. Not individual buyers, but the type of buyer. This second essential element begins with that step. Step 2 is develop a 2 or 3 page abstract, crafted specifically to attract the buyer type you identified in Step 1. Step 3, post the listing information. This data is derived from the abstract and tailored to the appropriate listing platform or websites or the buyers you're targeting. Step 4 is finalize the offering memorandum. Get this comprehensive document done quickly and ready for qualified buyers because you're going to get a lot of action when your business is first listed. Step 5, respond to leads. When inquiries come in, immediately send the abstract and an NDA. Templates for both of these are available in the Brokers Roundtable Resources section, and links are in the description. Step 6, receive the NDA. When you receive the NDA, what's next? But arguably the most important. Step 7, vet the buyer. The buyer must be vetted before going any further. We've covered the vetting process in our video on vetting buyers, which I've linked to in the description. And you have to do this because not all inquiries are serious and not all buyers are capable. To protect your business by protecting your information, you've got to know that the buyer is real. So you want to vet a buyer for financial capability, operational capability, acquisition experience. Have they ever done this before? Motivation, timeline. Are they thinking of buying now or are they just looking around waiting for another year or two? Capability and compatibility. Only after that step do you go to Step 8, sending the offering memorandum to vetted and qualified buyers only. That's how you maintain control, protect confidentiality, and protect your business. And that's how you create a professional process. Now, why does this structure matter? It does because buyers take cues from the process. A disorganized marketing campaign suggests a disorganized business. A structured, controlled, professional process signals competence and increases perceived value. Remember what we said in the preparation and planning video? We want to make it easy for the buyer to buy. We want to provide clear, comprehensive, and understandable materials. We want to control disclosure of proprietary and confidential information, and we want to do so in clearly defined steps. But this structure, incidentally, matters even more to the seller. The random disclosure of confidential information can destroy a business's value. Now, here's a true story. We were not involved in this deal, but we learned about it and we got some details from people who were involved. A business owner was getting ready to sell his business. He had made the determination that it was time to sell. So he drafted a short description of the business and stated that he wanted $1.7 million for this business. He put it up on Facebook and he listed it in 1 or 2 of the business for sale listing websites. And all hell broke loose, as it will with any initial listing. All of a sudden, he started getting all of these inquiries, and they all said the same thing. Send me more information. Well, he hadn't considered it at this point, so he did not have all the information, whatever that defines, ready to go. So he spent the next 2 weeks, 2.5 weeks, gathering all sorts of information that he thought these people wanted to know. And so the first concern, of course, is most of these business or these supposed buyers will never buy a business. Most of them aren't qualified to buy a business. The second thing is he spent the next 2.5 weeks gathering information that they may or may not even want it. Even the one or two people that could be buyers. He spent all of this time to the detriment of his running his business. So his business suffered. Not tremendously at this point, but it suffered nonetheless. So he gathered all of this information after 2 or 3 weeks of this intense work doing so and sent it out. And he was pretty giddy with joy that these 100 or 200 people expressed interest in his business. It said to him, well, my business must be worth something if these people are all interested in it. But he failed to recognize that 98, 99% of those people were not interested in the business. They were tire kickers. They knew they were tire kickers. Some may have been competitors' straw men, and they were trying to find information. And so what ended up happening, shortly after he sent all this information out, and of course while he was preparing it, more inquiries were coming in, he sent all this information out, and all of a sudden, very quickly, his employees started to hear that the business was for sale. His lender started to hear that the business was for sale. His customers started to hear that the business was for sale. Now, all of a sudden, he had a completely new set of fires that he had to put out. Weeks of work to try and keep everybody happy and to calm their nerves. The lender was thinking about calling a loan. 2 employees left because they weren't sure about their jobs. A couple of customers left or started to look for other suppliers of the product or service that this guy offered and that they had bought in the past. His business was damaged significantly. So the idea here is that the process needs to be followed, and confidentiality needs to be paramount. So we're kind of at the end of this here, but here's a final consideration. A final question for you. Should you bring your business to market with a price or without a price, using a bid or an auction process? Now, we've addressed this issue far more deeply in an earlier video, which I've also linked to in the description. And there are certain circumstances where listing with a price makes sense. But there are other circumstances that it does not make sense, because putting a price on a business limits the upside. Very important thing to consider. Now, just briefly, that decision depends on the type of business and its size and essentially the business in question. It depends on the norms in the industry. It depends on how confident you are in the valuation of your business. There are no universal rules in this when making a decision on this, but check out that video, which I've linked to in the description. So the bottom line here is that listing a business is not just putting it out there and hoping for the best. You don't want to put a sign on the building. You don't want to put a sign on the property. If you want to get the highest value for your business in the shortest amount of time and the smoothest transition with the least aggravation, you need to take these steps. Identify the right type of buyer. Control the information, protect confidentiality, create a structured access of deeper disclosure, and maintain your leverage. Done properly, marketing generates competition. Done poorly, it exposes your business's confidential information, which will result almost immediately in damaged value. In our next video, we'll discuss the third essential element of selling a business successfully: receiving and responding to a letter of intent or a purchase agreement. This is a major point in an owner's journey, and an owner can be giddy with this response. When an LOI or a purchase agreement arrives, however, an entirely new set of emotions takes place and a mindset shift is required. We'll discuss in that video what receiving an offer means, what it doesn't mean, and how to negotiate it properly. So subscribe so you don't miss that next video. Now, aside from the videos I've mentioned in this episode, you'll find additional links in the description to other resources on how to value, market, and sell businesses. If you found this video helpful, hit that like button. I'd appreciate it. And don't forget to subscribe. And as always, thanks for watching. I'll see you in the next video.